Look at your portfolio. Look at the headlines. It feels like a gold rush, doesn't it? Nvidia printing money faster than the Fed. Every CEO on earnings calls shouting AI 50 times to boost their stock price. They tell you this is the fourth industrial revolution. They tell you if you aren't all in, you're getting left behind. I'm here to tell you that they are lying to you. We aren't at the beginning of a revolution. We are at the peak of mass delusion. This isn't sustainable growth. This is the greatest financial bubble since 2000, puffed up by hype, debt, and promises that mathematically cannot be kept. Welcome to the AI bubble.
Let's be clear. Artificial intelligence is real technology. It will change the world eventually, but the market valuation of AI right now, it's pure fantasy. We are seeing trillions of dollars in market cap added based on vaporware. Companies with zero profits and barely a prototype are trading at valuations that would make the dot-com era blush. Why? Because Wall Street needs a new narrative to sell you. To understand where we are going, you have to understand where we've been. History doesn't repeat, but it rhymes perfectly. 1999, the internet was the future. Any company that put .com in its name saw its stock triple overnight. Pets.com, Webvan, they had no revenue models, just eyeballs and hype. Investors poured billions into infrastructure that nobody was ready to use yet. Sound familiar?
Today, the hype isn't .com, it's generative AI. And the shovel sellers in this gold rush are making a killing. Nvidia, AMD, the chip makers, they are selling the picks and shovels for a mine that hasn't produced any gold yet. These massive tech giants, Microsoft, Google, Meta, are caught in an arms race. They are spending hundreds of billions of dollars building massive data centers filled with H100 GPUs. They are buying chips like they're going out of style because of FOMO, fear of missing out. If Google builds a 100,000 GPU cluster, Meta feels they need 200,000. But here is the dirty little secret they don't mention in the press releases. The electricity cost, the cooling cost, the sheer capital expenditure is unsustainable. They are building infrastructure for demand that does not exist yet. David Kahn from Sequoia Capital calculated that for the current AI infrastructure build-out to pay off, the AI industry needs to generate about $600 billion in new annual revenue. Right now, it's generating a fraction of that, maybe $50 billion, generously. We're digging a $500 billion hole in the ground, hoping money starts shooting out of it. Think about it. We're building the equivalent of the interstate highway system before the automobile has even been mass-produced. It's an infrastructure bubble. Remember the fiber optic glut of 2000? Companies laid millions of miles of cable, convinced internet traffic would double every 3 months. It didn't. Over 95% of that fiber went dark, unused. Billions of dollars of capital was incinerated. The companies that laid it went bankrupt. That is exactly what is happening with GPUs right now. Companies are panic buying GPUs. They don't even have the power or data centers to plug in yet. They are hoarding them like toilet paper during the pandemic. And when the board of directors starts asking, where is the return on investment for this $10 billion cluster, the CEOs won't have an answer. That's when the CapEx spending stops. That's when Nvidia's orders dry up. That's when the music stops. But the infrastructure trap is just the first layer of this deception. The second layer is even more insidious. It's the productivity miracle myth. They tell you AI is going to make everyone 10x more productive, that it will automate away all the drudgery and unleash a new golden age of human creativity. It's a great sales pitch, but in the real world, AI is currently best at creating mediocre content very quickly. It's not replacing workers, it's often just creating new tasks, prompting, fact-checking, and editing the AI's output. It's a tool, not a magic wand. And then there's the App Store problem. Remember when the iPhone came out? The real money wasn't made by the 10,000 flashlight apps. It was made by Uber, Instagram, Airbnb, companies that used the platform to build entirely new business models. We aren't seeing that yet with generative AI. We are seeing thousands of wrappers, companies that just put a new user interface on top of OpenAI's models. They have no defensive moat. They have no unique data. They are doomed. They are competing on price in a race to the bottom. As soon as OpenAI or Google releases a tiny update, their entire business model evaporates overnight. This isn't a thriving ecosystem of innovation. It's a saturated market of copycats, fighting over crumbs while the real profits flow back to the infrastructure giants. So who is actually making money? The landlords, the cloud providers, Microsoft, Amazon, Google. They are charging a tax on every AI interaction. They are the only ones with the scale to run these massive models efficiently. Everyone else is just a tenant, paying rent in their digital kingdom. And this leads us to the biggest question of all. Is the technology actually good enough to justify this trillions-dollar valuation? The answer is complicated. We've all seen the impressive demos, but anyone who uses these tools daily knows about hallucinations when the AI confidently invents facts. For a casual user, it's funny. For a Fortune 500 company trying to automate customer service or legal review, it's a massive liability. Then there's data privacy. Are companies really going to upload their most sensitive proprietary data to a black box model owned by Microsoft or OpenAI? The friction for real-world enterprise adoption is much higher than the hype suggests. We are hitting a wall between cool demo and business-critical application. But the biggest threat to the AI bubble isn't technical, it's political. Governments around the world are waking up, and they are terrified. They see the potential for mass disinformation, cyber attacks, and massive job displacement. They aren't going to sit back and let big tech run wild. The European Union has already passed the landmark AI Act. It's the strictest regulation yet, imposing massive fines and compliance costs on foundational model providers. In the US, the FTC and DOJ are already launching antitrust investigations into the partnerships between big tech and AI startups. They see another monopoly forming. What happens when you add millions of dollars in legal and compliance costs to companies that are already unprofitable? The bubble pops even faster. And we haven't even talked about the copyright lawsuits. The New York Times, artists, authors, they are all suing. If they win, the entire training data model for these AIs collapses. Now let's add the final ingredient to this toxic cocktail: geopolitics. The entire AI boom is built on one single point of failure: TSMC in Taiwan. They manufacture over 90% of the world's most advanced AI chips, including every single one from Nvidia. China has made it crystal clear that they intend to reunify with Taiwan. If China blockades or invades Taiwan, the supply of AI chips stops overnight. It wouldn't just be a recession, it would be a global economic depression. The entire tech sector would grind to a halt. The AI bubble wouldn't just pop, it would vaporize. So, what happens when all these forces converge? The infrastructure trap, the lack of profits, the regulatory hammer, and the geopolitical threat. The Great Unwind. It won't be a slow leak. It will be a violent, chaotic rush for the exits. And the retail investors, the ones buying in right now, will be the ones holding the bag. Look at Nvidia's chart. It's a classic parabolic curve. In financial history, every single parabolic curve has resolved in the same way: a devastating crash. The insiders, the VCs, the executives, they are already selling. They are cashing out while the hype is at its peak, transferring their risk to you. We saw it in 2000, we saw it in 2008. The mechanism is always the same: excessive leverage, mass delusion, and a belief that this time is different.
Sir John Templeton said the four most dangerous words in investing are, "This time is different." It never is. Gravity always wins.
So the trillion-dollar question is, when will it pop? No one knows the exact day, but the cracks are already visible if you know where to look. The infrastructure build-out is slowing. Insider selling is accelerating. The regulatory walls are closing in. The smart money is getting cautious. This isn't the time to be greedy. This is the time to be terrified. The party is ending, and the hangover is going to be brutal. But a crash isn't the end. It's a reset. For those who are prepared, it's the greatest opportunity of a lifetime. In the next section, we're going to show you exactly how to protect yourself from the fallout and how to position yourself to profit when the dust settles. The first step is psychological. Stop chasing the shiny object. Forget FOMO. The easiest way to lose money right now is blindly buying an AI ETF because your neighbor did. If you hold individual tech stocks, look at their valuations. Are they priced for perfection? If a company needs 50% growth for 10 years just to justify today's price, sell it.
Look outside the bubble. Boring is beautiful right now. Healthcare, consumer staples, utilities, companies with real cash flow that don't depend on a narrative. Consider defensive assets, gold, short-term government bonds, cash. Yes, cash gets eaten by inflation, but it doesn't drop 80% overnight like a popped bubble stock. For the sophisticated, aggressive investors, there are ways to profit from the downside. Put options, inverse ETFs. But be warned, trying to time the top is dangerous. As the old saying goes, shorting a bubble is like picking up pennies in front of a steamroller. You might get a few, but if you trip, you get crushed. The best strategy for most people is patience. Keep your powder dry. Wait for the crash. Wait for the despair. That is when fortunes are actually made. Look at Amazon after the dot-com crash. It lost over 90% of its value. But if you bought it at the bottom in 2001, you secured generational wealth. Your job right now isn't to chase the hype. It's to identify the real companies that will survive the purge. The ones with real products, real customers, and real moats. This requires actual work. Reading 10Ks, understanding balance sheets, ignoring the CNBC cheerleaders, and looking at the cold, hard cash flow. If you want to survive this, you have to disconnect from the hype machine. The media wants you anxious and clicking. They don't care if you go broke. Prepare your portfolio now. Build your cash reserves. Know your buy list. And then wait, because the crash is coming and it will be a massive opportunity. Now, let's zoom out. Does this bubble mean AI is fake? Absolutely not. The technology is revolutionary. The internet was revolutionary in 1999 too. AI will eventually rewire the global economy. It will solve massive problems in healthcare, energy, and logistics. That future is coming. But the financial vehicle delivering that technology right now is broken. It's built on debt and delusion. The crash is necessary. Think of it like a forest fire. It's destructive, yes, but it clears out the deadwood, the fraud, the hype, the unprofitable zombies, so real growth can begin. The real AI economy won't be built on hype cycles and PE ratios of 200. It will be built on tangible productivity gains and sustainable business models. In the final section, we're going to look at the end game. Who will rise from the ashes of this crash to become the true titans of the AI era? The future isn't about talking chatbots. It's about AI integrating silently into the backbone of the economy. Energy, logistics, healthcare, manufacturing. Watch the energy sector. AI's massive power demands will force a revolution in energy production. The companies that solve that bottleneck will be enormous winners. Watch robotics. When AI gets a physical body and can navigate the real world, that's when the true industrial revolution begins. That is decades away, not months. This is the disconnect.
The market is pricing in the 2040 reality for 2025 earnings. That gap is where investors are about to get slaughtered. The AI revolution is real. The AI bubble is also real. Confusing the two is the most expensive mistake you can make right now. For more rational analysis in an irrational market, subscribe to Money Nexus. We'll see you on the other side of the crash.